Welcome back to American Money 101. Today, we're going to tackle one of the most common financial decisions that could be holding you back from building wealth: buying a new car. With car prices on the rise, high interest rates, and the hidden costs that come with ownership, many people don't realize how much buying a new car can hurt their financial future. Let's dive into 8 key reasons why a new car purchase is usually a financial mistake. And be sure to stick around for reason number 8 as we do a deep dive into the hard financial facts and calculate the true cost of purchasing a new car. And I promise these numbers will shock you. Point number 1, depreciation is a wealth killer. Now we're going to use a $60,000 new car example. Depreciation is one of the biggest financial traps of buying a new car. As soon as you drive it off the lot, its value plummets. As an example, for a $60,000 new car, you can expect a 10% drop in value the moment you drive it off the lot, which means you lose $6,000 immediately. By the end of the first year, the car could lose up to 30% of the value, leaving it worth only $42,000. And over the first 5 years, your car could lose an astonishing 50% of its value, meaning it will only be worth $30,000. So what can you do instead? Have you ever heard someone say you're better off buying a used car? Well, here's what that means. A 2 to 3 year old certified pre-owned car has already gone through the steepest part of depreciation. Now, you'll still get a reliable vehicle, but it will cost you significantly less upfront with better value retention over time. For example, a 3-year-old car might cost around $35,000, saving you $25,000 upfront, which could go towards building wealth or paying off debt. Point number 2, financing closing costs, the true price of that new car. Financing a new car comes with hefty costs, especially with interest rates currently hovering around 7%. This adds a significant amount to your total price. If you finance a $60,000 new car with a 7% interest rate over a 5-year term, you'll end up paying around $11,300 in interest alone. So instead of $60,000, the real cost of that car is about $71,300. And here's the kicker. By the time the loan is paid off, your car will have depreciated to around $30,000 in value or less. You've essentially paid more than double the car's end value, which isn't a smart financial move. Now, if financing is a must, consider a lower cost used car. A car less expensive will save you thousands in both principal and interest payments, allowing you to put more money toward your wealth building activities like investments or saving for a home. Point number 3, opportunity cost, the money you're missing out on. One of the most overlooked downsides of buying a new car is the opportunity cost. This is the money you could have made by investing that $60,000 instead of spending it on a depreciating asset. Now here's an example. Let's say that you invested that $60,000, earning an average return of 10% annually. After 10 years, your investment could grow to around $156,000. In 20 years, it could reach around $420,000. Now compare that to the car, which is worth $30,000 after 5 years and continues to lose value as time goes on. Here's some more food for thought. What else could you have done with that $60,000? You could have used it to pay off high interest debt like credit cards, freeing up more money each month for saving and investing, or make a down payment on a home, which is likely to appreciate in value over time. When you buy a new car, the opportunity cost is one of the biggest missed chances to build wealth. That $60,000 could have set you up for a much brighter financial future. Point number 4, higher insurance and maintenance costs. Now, new cars don't just cost more upfront, they also come with higher insurance premiums and maintenance costs. According to Value Penguin, the average insurance premium for a new car is around $1,400 per year, compared to around $1,100 for a used car. Over 5 years, you're paying about $1,500 more in insurance alone. You might be aware, but the insurance industry is going through a huge disruption right now, and these premiums are only expected to increase from here on out. And here's something else to think about. As cars become more complex with advanced technology, the cost of maintaining them also goes up. Repairs on new models are generally more expensive due to the specialized parts and systems. The hidden cost of insurance and maintenance can quietly eat away at your budget, making a new car even more of a financial burden. Point number 5, car payments and financial freedom. Using 2024 figures, the average monthly car payment for a new vehicle is now over $750 a month. Over a year, that's $9,000, and over a typical 5-year loan, you're looking at $45,000 just in payments. Now, in Dave Ramsey's The Total Money Makeover, Ramsey stresses how car payments can be a massive obstacle to your financial freedom. Every dollar you spend toward a car payment is a dollar that's not being used or invested to build wealth. Dave's advice is to avoid financing cars altogether. Buying a used car with cash frees up income that can then be directed toward investments or savings, which helps grow your net worth rather than shrinking it. Point number 6, financial experts' opinions on why new cars are a bad investment. I've already referenced Dave Ramsey, but Susie Orman and Clark Howard are just a couple of additional financial experts who consistently warn against buying new cars. Orman says that purchasing a new car is one of the biggest mistakes you can make with your money because of how quickly they depreciate. She even argues that if you can technically afford a new car, it's not a smart financial move if you're still working toward financial freedom. Every dollar you spend on a depreciating asset is a dollar that's not working for you. And Clark Howard agrees, stating that people often get emotionally attached to the idea of a new car, but they don't realize how much it drains their financial wealth. Howard suggests looking at the bigger picture. Wealth is built through appreciating assets, not depreciating ones like cars. The advice from these and other experts is clear. New cars may look nice, but they'll never help you reach your financial goals. Point number 7, survey on car regret. The stats don't lie. According to a Bankrate survey, 52% of Americans regret buying a new car within just 2 years of the purchase. The main reasons? High payments, fast depreciation, and unexpected maintenance costs. Many people in the survey said they felt pressure to buy a new car to keep up with social expectations, but quickly realized that the financial strain wasn't worth it. Respondents often wished they had bought a used car or kept their existing car longer to avoid the financial burden. What this shows is that the excitement of a new car wears off really quickly, while the financial impact lingers on for years and years. Point number 8, the full financial picture, the hard numbers. Let's look at the hard financial facts when it comes to buying a new car. First is depreciation. A $60,000 new car loses $6,000 immediately and up to $30,000 in the first 5 years. The second is financing. With a 7% interest rate, a $60,000 loan costs you an additional $11,300, meaning you're paying $71,300 for a car that will only be worth $30,000 after 5 years. Third is the opportunity cost. If the $60,000 was invested, instead it could grow to $156,000 in 10 years and $420,000 in 20 years. Fourth is insurance and maintenance. You'll pay around $1,500 extra in insurance over 5 years, and maintenance costs on new cars are typically higher. And the fifth is the car payments. Over 5 years, you'll spend $45,000 on payments, which could have been used for wealth building. All of these financial factors together make buying a new car a costly decision that can hold you back from reaching your financial goals. If you are considering buying a new car, I'm asking you to pause, reflect, and reconsider. Buying a new car may seem exciting, but when you look at the numbers, it's often a financial mistake. The depreciation, interest, and lost investment opportunities add up, taking a big chunk out of your future wealth. Think carefully before committing to a new car and consider alternatives that keep more money in your pocket and help build wealth. Now, the decision is still yours, but make sure you are making an informed financial decision based on your own best interests. This is Benjamin Adams with American Money 101. Until next time.